Cryptocurrencies, usually referred to as virtual currencies, are digital representations of value that are utilized as trade mediums in lieu of traditional paper money. Digital currencies have been more widely accepted and used by the public for a range of activities during the last 10 years. Cryptocurrency, which is often praised for its use as a financial tool, is gaining popularity across a wide range of businesses. A new set of laws and guidelines controlling the taxes of every transaction done in virtual form also accompany it. Governments must implement the correct regulatory framework to enable proper taxation of digital currency transactions as more individuals adopt the use of virtual currency. Therefore, the goal of this paper is to clarify the benefits of cryptocurrencies and how they affect taxation procedures, while also demonstrating mastery of the tax laws and reporting requirements for cryptocurrencies, not only Bitcoin, historical context, due to its decentralized design and robust security mechanisms. Cryptocurrencies like Bitcoin have attracted the public's interest. This is because they essentially eliminate any risk of double spending or illegal transactions from occurring. As a result of all operations being disclosed, the blockchain's transparency, the software public ledger preserving each transaction, was considerably strengthened, offering investors the convenience of protection from fraudulent activities as well as the confidence of making the right decisions. This revolutionary technology's potential generated interest in it globally by increasing demand for and the value of other cryptocurrencies like Bitcoin, Ethereum, and Ripple. Due to its fast growth, the European Central Bank classified cryptocurrencies as commodities, and several nations, including the United States and EU members, have implemented regulations pertaining to them. Tax treatment of cryptocurrencies. The tax system consists of a number of elements, such as basic capital gain taxes and exclusions for certain short and long-term situations. When trading cryptocurrencies, specialists in the field advise that one adhere by the following tax regulations. General provisions for capital gains. Any gain from cryptocurrency trades is taxable under the appropriate income tax system. General provisions for capital gains. In order to ascertain the precise tax obligations, investors should also compute their net capital gains at any given time. Long-term versus short-term exemptions. HMRC, Her Majesty's Revenue and Customer, has set out distinct rules for tax exemptions for long-term versus short-term designations. 4. The rules limit cryptocurrency owners' exemption from fees for exchanges to purchases made within a 90-day period cumulatively, and they also fail to accurately reflect the cost structure. Therefore, any cryptocurrency purchased by a buyer before the 90-day cutoff should be seen as a long-term investment. Additionally, failing to qualify for either of the two categorized exemptions, in the HMRC's opinion, results in the assessee having to pay the whole amount of capital gains taxes due. Additionally, this improves the process of compiling the list of required investments, particularly in light of compliance with the 90-day framework. Electronic filing requirements. It is categorically necessary to file taxes on a regular basis in order to augment payments. Significant technical advancements have made it possible for taxpayers to use the services for obtaining thorough transaction records securely and effectively without leaving their homes, thanks to tools like the Digital Currency Tax Data Capture tool. Users may also immediately combine the raw data to an interactive CSV file for manual filing using various channels, such as the Coinbase IRS Tax Return CSV generator. By utilizing the digital tool to file your tax returns, you may do so without having to manually process your accounts or provide transaction data, which are both necessary for the accurate application of income tax legislation. Therefore, in light of the recent emergence of the use of digital currency in significant transactions, any omission from or incorrect interpretation of the rules by the general public might lead to significant losses as a consequence of different national taxes duties. Categorization process. The European Central Bank has established 4 categories of cryptocurrency, each of which is subject to a separate set of tax treatment rules. 7. Setting up a robust taxation structure would lessen market uncertainty and improve the fairness of how digital currency is taxed. The categorizing process is a result of the distributions of those currencies via ICOs initial coin offerings, which count as either security tokens or utility tokens, considerably altering the application of taxes within their respective markets. Security tokens must adhere to considerably tougher capital gains tax laws, as well as deposits for currency exchange institutions into financial instruments, FI, in order to meet regulatory requirements. The Securities and Exchange Commission, SEC, of the United States conducted the first analysis of security tokens. Taxation on stocks versus cryptocurrency. The usefulness of the product being invested in is the key distinction between the taxation of stocks and that of digital currencies. Cryptocurrencies trade as commodities aligned with supply and demand features, implying primarily marketable value, in contrast to conventional equities that produce dividends given back by an organization or listed stock exchange. Companies that encourage unregulated investment may be classified as securities with respect to the United States in the context of security token issuance, depending on the relevant jurisdiction. Utility tokens, which distinguish themselves as tokens with functionality not available from centralized exchanges, often specify all products and services that are eligible for the performance satisfaction suggested by their white papers. These must always make touch with detail actors and rely on a duty-bearing surface. Tokens hosted by exchanges run the danger of having ownership rights converted into an investment security token subject to foreign taxes in certain situations. 9. Digital currency tax, scenarios. Example 1. Alvin trades cryptocurrencies and currently owns both Bitcoin and Ethereum. On December 31st, he closes a deal with a $1,000 profit. This profit is recorded as long-term ordinary income and is taxed at the local jurisdiction's capital gains rate. Example 2. On August 28, Anne, an Ethereum investor, completed a transaction. Since she purchased the transaction on October 6, 85 days before, it is considered a short-term gain and is subject to the local jurisdiction's capital gains tax rate. Example 3. Robert had amassed his Bitcoin, but he didn't start trading with them until 2 months ago. He is an American national who resides in Hong Kong and trades on the AAX platform. Robert has not yet completed the electronic filing obligations associated with his trading activity on the AAX. Conclusion: financial technologies, such as cryptocurrencies, often negotiate several jurisdictional behaviors that are mapped in a way that makes it possible to maximize profit via effective techniques, which includes making informed decisions and paying taxes in a suitable manner. It first sped up the creation of rapid judgments for investors based on the volatility of the cryptocurrencies themselves, improving the technology to enable maximum earnings without paying taxes. The legalization of the jurisdiction as an asset class over time compels its practitioners to follow recognized legal guidelines, leading to substantial changes in the sector, including responsibilities to pay income taxes based on the assessee's location. Setting the appropriate rules across culturally varied nations and having the necessary knowledge makes it simple to connect various financial processes. Thousands often need to negotiate evaluations as they plunge further into the seas of interpreting these tax levies, since the value, usefulness, and legal situations come and stay different between each nation, from the US to most of Europe. It is crucial to be made clear, since different choices may successfully diverge from unfamiliar norms, giving the newest popular cryptocurrency investors total delight. This is it for today's video. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe to our channel, The Crypto World, for more future updates. Thanks for watching.